Okay, we're taking a look at establishing a petty cash fund along with replenishing a petty cash fund, and this is Chapter 7-6A in your textbook. So a petty cash fund is simply having a certain amount of money in your office that you can use for small expenses, okay? So what happens is we've decided that we're going to have $300 in our office, so somebody writes a check for $300. That's why we're crediting cash. We take it to the bank, we ask for some change, and they give us some different denominations that we can have available to pay for certain items. So in the process, we're also establishing a new account called petty cash. Nothing's going to happen to that petty cash account unless you close it or change the amount that we're going to have there. So you'll never touch that petty cash account again. So then what happens is throughout the month, we spend the money. We have a telephone expense, an automobile expense, maybe we changed our oil, the owner took out some money, we had to buy stamps, somebody came in and wanted a charitable contribution, and then we had a miscellaneous item. So if you can think physically of what's going on here, at the end of the month, we have a receipt in the bag or our box for every single one of these items, and then we also have $74.90 because we started with $300, we spent $225.10, which leaves us with $74.90. So what we want to do at the end of the month then is we want to replenish that. We want to bring it back up to $300. So this journal entry on the 31st is what we do to replenish it. We need to go ahead and record where we spent all of our money. That's why we're debiting all these accounts for what we spent the money on, and then we're crediting cash for the total. So what happens now is we have a check for $225 that we're going to go to the bank in cash and put it back into our petty cash fund. So we're back up to the $300 that we started with. We had the $74.90 left, and now we're putting the $225.10 back in that we spent.